This filmmaker made $400,000 and lost thousands to taxes just by structuring his business wrong. Let's talk about it. Your creative genius deserves the same precision behind the numbers.
Welcome to Let's Get Fiscal, hosted by Anastasia, Maisha, and Danielle.
Part of the women-led team at Coterie Tax.
From smart tax moves to cash flow strategy, we decode everything it takes to run a thriving creative business
so you can scale with confidence and sleep easy at night.
Press play and let's grow your business.
I'm really excited for this episode because we've talked about the theoretical, we've talked about the different definitions within the financial world, but like I love having like a real life example so that you can kind of see how things actually play out. So super excited about this one.
Right. So we have a few of our forms kind of right in front of us so that we can take a look and really go through the process of how we analyze a tax return and be able to provide recommendations so that if this is you, you know where to start asking questions and what things you should be asking for from your CPA or enrolled agent. Because again, if you don't ask, there's no guarantee that they're going to give you something.
Exactly.
So let's start to kind of frame that conversation that you can have with them. So I really love this as a great example because there's a lot of good things that we can do in this situation. So he did make $400,000 in this tax year as a sole proprietor. So there's no LLC, there's no corporation. That is totally fine. You can start a business without filing any documents with the state. You just start doing things and people pay you for it. That is where
so it's all under like your personal, like you as a person. Okay.
Post-production side note, we are going to be going through a lot of numbers and forms. So if you would like to follow along with us, come check us out on YouTube and you can walk through with us. So we have $400,000 in income. We've got some expenses and we end up with about $300,000 in profit, which is pretty standard for the kind of film and entertainment industry because most of it is service-based. Okay. So service-based businesses generally are going to have high profit margins because you don't have to buy inventory. There's no t-shirt or food or things that, you really need. You're selling yourself basically.
Yeah.
And that's going to be the biggest moneymaker. So in this situation, what we're kind of looking at is, as a sole proprietor, he's earning more than $100,000.
Okay.
So that's our first key, that he probably needs to have some sort of business structure.
Okay.
And so that's going to be number one. And then also number two, his profit is also very high.
Yeah.
So if the income was $400,000, but let's say selling clothing and you have a gross margin of 40% and all of this fun stuff, and he ended up with a profit of only $40,000, then maybe we would make a different decision. But again, because this is service-based, there is a high amount of profit. This is going to scream, number one, over $100,000. Let's get an LLC in here. And then number two, let's do a reasonable compensation review and see if the S corporation structure will help him, because a $300,000 in profit, we have to look at what are people in his position making as a W-2 employee, and is it common for them to be making over $300,000? And
I feel like that would be a no, like a high no. Yeah.
Most of the time. Yeah. I mean, I see that with a studio executive.
Okay.
With like a base fair. 300 plus a profit share bonus and everything. But yeah, for crew, that's probably not very, very common.
Yeah.
So what we did is we went through and we did a reasonable compensation study with him. And again, what we're looking at is how much time is he dedicating to the business?
Okay.
And what are the services that he's actually providing the business? So things like he's doing his own bookkeeping, he's sending out invoices to clients, He's doing his own marketing, handling all of the relationships with the clients, all of that fun stuff. So at the end of the day, once we layer in his core competency, what he's actually focused on, plus all of these other business operational positions, his reasonable compensation came to be about $75,000.
Okay.
So right now he's paying Social Security and Medicare on $300,000.
But he could have been paying it on the 75 if he was structured differently. Okay.
If he was structured
I'm
a
with
little
you
bit
still.
differently. So in this tax year, it was $30,000 for Social Security and Medicare. And when we think about the $75,000 payroll, that's Social Security and Medicare of $12,000. So right off the bat, by doing one thing, we've saved him almost $20,000.
That's amazing. Yeah. Yeah.
Right. That's enough. Some people use that to buy a house. You know?
Yeah.
I mean,
No.
there you go. So we've done one thing. We've saved $20,000. But one of my big things is we did that by decreasing Social Security and Medicare. And the purpose of paying into that is so that you have benefits in your old age.
Yes.
So we have $20,000 extra dollars. Technically, let's take all of that money and let's put it into a 401k. So instead of it going into a retirement fund that is government controlled, let's put it into a retirement fund that is controlled by the business owner specifically. And based on his income tax bracket, at the $300,000 kind of layered in, he's paying about 35% in income taxes. So by taking his tax savings, putting it into a 401k, which is tax deferred, that counts as a business deduction. And based on that, he's going to save another $5,000.
Okay. All right.
So we've saved $20,000 on Social Security and Medicare. We've put that money into his retirement. Now we've saved another $5,000 on taxes.
Nice. Okay.
And
we're already trickling it down. Yeah.
Right. So we have that. And then also, once we turn it into an S corporation, we're able to do something called the pass-through entity tax. So in this year, the client was not able to itemize because they don't own a home.
Okay.
So they took the standard deduction, but they paid more because the state and local tax limit, so they call it the SALT cap, is $10,000. And so he paid $25,000 in state income taxes, but he was only able to deduct as an itemized deduction $10,000. So at that point, it was more beneficial for him to take the standard deduction. So he's paying all this extra in state income taxes, and there's no benefit to him.
Yeah.
So when we convert the company into an S corporation, we're able to do the pass-through entity tax, where the business chooses to pay the state income taxes on behalf of the individual.
Ooh, okay.
So, and
sounds
because
nice.
the business is not required to do so, it counts as a federal income tax deduction.
Okay.
So now he's able to save 25% on his state income taxes that he already had to pay. So again, paid $25,000 in state income taxes. If he had his S corporation pay that, he gets to save another almost $7,000 in federal income taxes. So now we're kind of at like a $30,000 tax savings, and we haven't even really done anything.
Yeah, no, like we haven't dug through to like his expenses yet or anything like that. Yeah, that's literally just changing the structure. Yeah, and like how you're managing the business itself to like get the best things. Yeah, okay.
Right. And so I can see in here, he paid $3,500 for accounting services in this tax year. I normally say if you want to have an S corporation, you need to invest minimum $6,000. So if you could pay $2,500 and someone will give you $30,000 where you would more than 10x, I mean, and that's where a lot of people see the big numbers from tax strategists and say, okay, well, I paid the last guy $300. Why am I going to pay you $6,000? And this is why.
Yeah.
It really is, you get what you pay for in those situations. So paying extra so that the person can take the time to create the strategy and make sure that you stay on point with that strategy is a huge deal. And that's another reason why the IRS comes in and they say, okay, so this guy made a profit of $300,000, but he didn't want to spend $2,500 extra to save $30,000.
Yeah. Yeah.
So there might be something else that's going on in here that we can dig into. And obviously he's got enough money for us to
make it worthwhile to
make
do
it
so.
worthwhile.
So you can even look a little bit more fishy, I guess, or like at least like we got to take a closer look if you are just like making a crazy amount of money, but like there's no structure really in place.
Right.
Okay.
Right.
Okay.
Because like I said, if they can see that you have a lot of money, but you're not investing it in your accounting services and like you said, the business structure and operating the business, then they know that you're going to kind of be a weak link and they can go after you.
Okay.
Because you don't have the structure. You don't have a strong team behind you.
Yeah.
So that's another thing. So to recap, what we've done is we've recommended an LLC, taxed as an S corporation, done a reasonable compensation study, pinned his reasonable compensation at $75,000, and recommended using the tax savings to fund a solo 401k, and then also taking advantage of the pass-through entity tax. So that's easy. That's the easy stuff. So now we're going to get into some of the larger items that I think are really good from a planning perspective that are a bit more complex. So when we look at it, number one, we want to really focus on bookkeeping for the client, making sure that everything is in the correct bucket. Because again, like I said, they don't argue that you spent money. They just argue that it's not in the appropriate location. And things like that. So we want to make sure that bookkeeping is used to tell an accurate and really strong story of the business. And then as the business owner is continuing to earn money, yes, in this year they would have saved $18,000, but as income increases, we want them to take even more money and put that into the 401k. So this year you can do $23,500 as an employee. Plus we could also do 25% of their payroll as a profit sharing to get that number even higher. So now we're saving even more money there. And then from there, especially when you have a high income service-based business that has a lot of profit, this is where people talk a lot about Airbnbs. And that's where it comes into play. So we have some free cash and, $300,000, you can pay 20% down on a $750,000 home with $150,000, then you still have $150,000 to live off of. Now, what is the benefit of doing that? So if you have the Airbnb, it's considered an active business as long as the average stay is below 7 days. And then we're able to take any of the losses that are generated from the Airbnb and use it to decrease this profit. And so what we do is we do a cost segregation. So again, if we use this $750,000 house, depending on the land, the value of the land and all of that fun stuff, I'm just going to say, let's say they said that between the 5-year and the 15-year property, it's $200,000. We're going to use bonus depreciation, just back at 100% to write off $200,000 in expenses. So he started out with $400,000. He had a profit of $300,000. We're taking $150,000. We're turning it into $200,000 worth of expenses. He's at 35% tax bracket. So now he just saved $70,000 on his taxes, which basically completely wipes out his income taxes for this year.
Yeah. So
and he has a property. He has an investment property that he's able to use that will continue to appreciate in value. And then ideally, under the Airbnb structure, you choose a location that the property would generate enough income to cover the mortgage and any of the normal expenses that it generates.
So technically, like then two businesses kind of thing. Yeah. Like turning it into two things and also getting the income tax like way lower than the current structure he has here, which is none.
Right.
So, yeah. Okay.
Right. So that's like a big picture item. And Airbnbs, they can be a lot of responsibility. So especially if this is someone who is in maybe pre-family planning, maybe by the time they have a baby, they don't want to deal with Airbnb anymore. So what I also love to do as a recommendation is Airbnbs, normally they're out in some kind of vacation place like Big Bear or, something like that where there's a nice lake. It looks great. Once you've kind of collected on that first, second year of losses, what you can do is you can, because it's a business property, you can go into a 1031 exchange where you're basically saying, I have this house and I would like to trade you my house for your house.
Now, why would someone want to do that?
Because property appreciates in value, and especially you've probably done some renovations and things like that. What that allows you to do is you are able to take possession of the other house without recognizing any of the capital gains on the property. So if you sold the house for cash, you would have capital gains tax come in, and then you would be using that cash to purchase another property. What we can do is we can do a straight trade, and then we defer all of those capital gains. And then what's really fun is after a 1031 exchange, you wait 2 years so you can buy a house in the city that you love, put in a long-term renter in there so that it's generating the cash. It's not a huge responsibility, a heavy lift for you. And then after 2 years, you can transfer the property to yourself and it can be your primary residence and you can live there. And now you just bought your forever home. So you basically paid the $70,000 because you got $70,000 worth off on your taxes. And then you were able to renovate it, get all these tax savings, do all of these things. And then kind of when you are ready, you were able to convert it into your forever home using the appreciated value of that property to buy in the area that you really, really love. So that's like a big picture.
I know, but like, isn't that so crazy? Like just having a good plan in place, like you can do something like that. Like not everyone just doesn't know that. So that's really cool. You like take a look at someone's tax return and be like, well, we could get you a forever home. Like if we follow this plan, like we do all of these things with lots of tax savings. That's amazing.
So that's kind of the long-term picture, 5-10 year goal that I would say. Kind of going back to more short-term, again, if they are pre-family planning, then I would say let's get a high deductible health insurance plan because there's more than enough money for him to be able to cover his deductible. So what that enables him to do is open up an HSA and an investable HSA. So an HSA, it's a health savings account and it's only available if you have high deductible healthcare plan because a high deductible means, it's going to cost you a bunch of money in order to pay all these doctor's visits. So you're able to put money into this special savings account. Whenever you put the money into the savings account, that counts as a tax deduction. And then if you put it into an investable account, then it can earn interest and dividends and grow. And then when you take the money out, you don't have to pay taxes on it. So no tax going in, no tax coming out. Plus you're taking out more money than you put in initially. So
that's a great short-term plan. Yeah.
And again, I mean, it maxes out at $4,300 for the year, but it's still a couple of $100 that he would get tax-free, off on his taxes to be able to do that. And then also because we are maximizing the solo 401k, putting a whole bunch of money in there, that's going to be a tax deferred account. So we have to keep in mind that those accounts have to be empty at the end of life expectancy.
Okay.
So we don't want to put all of our retirement money into tax deferred, because then that's where you get into situations where you make more money in retirement than you do when you're working. So in this situation, I would recommend starting a backdoor Roth.
Okay.
So that's where you take an empty traditional IRA, one that has no funds in it. You deposit your maximum $7,000 into that traditional IRA. As soon as it hits the account, you ask them to convert it into a Roth. And then because you're doing it immediately, there's no gains or minimal gains in the account. So it doesn't create a tax liability. And then it's in the Roth and you're able to grow all of the account tax free. You can take it out whenever you need to, all of that fun stuff. So I like to have that Roth kind of growing in the background. And then if there are, because again, in film, there are kind of highs and lows.
Yeah.
So that's also where, especially in one of these years where we have a higher tax liability, we're going to put as much money into tax deferred retirement plans. And then in some of the years where maybe there's a little bit of a slump, then we'll do a mega backdoor Roth and start converting some of that. And so the idea there is, when we deposit money in there, maybe he's paying 35%. But when we do a backdoor Roth, maybe he's paying 15%.
Yeah.
So now we have a savings of 20% in taxes when we're doing that conversion. So that really helps us. And then we're also bringing down those required minimum distributions in old age. So that's really fun.
I love your definition of fun. But okay. It is cool. It's like crazy how much just like a really good plan can save you though. Yeah. Okay.
And then because there's still more things that we can do. So especially when you're in film, entertainment, all of these creative spaces, a lot of times we want to give back. So a great way to do this, again, like I said, normally with charitable donations, you can only take advantage of them if you itemize. And he's currently not eligible to itemize. So what can we do? How can we make his charitable donations go even further? And that's when we open what we call a donor advised fund. So basically, we would take, especially since this is a higher income year, it would be a minimum of $25,000. We put it into a special account, and then that $25,000 turns us, so now we can itemize.
Oh, okay.
Because 25 is bigger than the 12. So now we can itemize. Now we can get that state and local tax deduction. We can do all of that stuff. And then with the donor advised fund, we don't have to spend all of the money immediately. So we get to take the deduction in the year that we fund the account. But then it can take 2 to 3 years for the owner to identify the specific charities that they actually want to donate to.
Gotcha. So they don't have to donate it all at once. They can like pick and choose and like use it as like a fund to the specific. Okay, that's really cool. Okay.
Yeah. So it's really just a bank account where they can say, okay, I want to give this charity $1,000 or this charity $500. You don't have to just pick one and really stick to it for the whole time. So they call it kind of bundling. Because we're taking multiple years worth of charitable donations and we're making a larger donation in that first year, but kind of behind the scenes, we're still doing those smaller donations as time progresses. And again, what's really great is because he's at that 35% tax bracket, by putting that $25,000 in there, he's saving about $6,000.
Okay.
Which again increases his ability for charity, like charitable activities.
Okay.
So that's really great. Like funding, they have little summer film schools and internships and things like
that's
that.
Awesome.
I mean, I think especially post-COVID, there were so many, up and coming people that didn't have a lot of that hands-on experience and things like that. So, kind of trying to build that back up, and build the industry back up is really, really important. So we have that.
Okay.
And then we can kind of get into other fun things.
There's even more.
Yeah,
okay.
I know. So especially a business owner like this that has income that's steadily increasing, Once the 401k is maximized, then we start talking about pension plans.
Okay.
And then also, again, if there's more of that charitable arm, you can also start investing in film production.
Okay.
So again, film production, in the first few years, they normally lose money. There's also credits on the state level and all of these things. So it can be a good tax planning strategy to fund some of these projects that you feel really strongly about, and you get a tax savings. And then ideally, once the production is released, then you get all of your initial investment back.
Okay.
Plus you also received all of the tax savings and the credits and things like that.
So cool. Okay.
So, I mean, even just starting off with saying, let's create a business. This is a great example for an S corporation. And doing nothing more really helps. But you can also see from the strategy how, depending on the lifestyle of the person, you know, are they really big into charity and, you know, kind of bringing up the next generation? Are they really focused on family planning? Are they really focused on investing? You know, really, what is that goal and how we can plan things out in
Based
a
off of
really, really super effective way. And now the taxes are working for you instead of against you.
Yeah.
So if you would like to save $30,000 every single year, put a comment below or schedule a consultation. Don't forget, you can check out our YouTube, be able to follow along. I know, like Maisha said, sometimes it's a little bit easier when you can actually see and feel the numbers. So I hope this gave you a little bit of insight and helps you create that conversation with your tax professional. Talk to you soon.
Bye.
That's a wrap.
On Let's Get Fiscal.
Ready to stop guessing and start saving?
Click the link in the show notes.
Grab your consult and let's make your business work for you.
Not the other way around. You've got this.